Hey guys, we thought we'd make a video covering basics of stock market, some interesting stocks that you can look at today, and how you can get started with a trading portfolio. We're looking at some long-term, short-term strategies, the power of compounding, how you can use it, what futures and options are, buying appreciating assets today, looking at some products that are available at cost that you can look at today, as well as how you can start with whatever budget you have in mind. So we'll be looking at what you can do with 10,000, 1 lakh, 10 lakhs, and 1 CR if you have that ready to invest. So for today, we have Vardhan. Vardhan's a very close friend of mine and has been investing in the market for the last few years. He's had a good and bad time doing it. COVID was, I'm sure, especially a learning experience.
Yeah.
So yeah, thanks for joining, Vardhan.
Sure. No, thanks for having me, to be honest. And I like investing. I like the stock market. So I've been doing it for a while. And it's just my passion now. So that's what it is.
So Vardhan, let's talk about like the first thing that you started investing in and how did you kind of get introduced to it?
Sure. So how I started investing. So I'm actually 24 years old, right? And I started investing when I was around 17, 18. And I remember listening to my grandparents and my dad and cousins talking about it, talking about the stock market, talking about different stocks to buy. So I honestly got my first inkling towards the stock market back then. And then I remember in my 11th grade, when I was in my 11th grade, I joined some stock market investing courses in school itself. So that gave me a good start and showed me how to value stocks and things like that. And then from there, when I was 20, 22, like about 3-4 years ago, I started investing in my personal portfolio and just small amounts, 10, 20,000 rupees a month. And then from there, it's grown from there.
That's awesome. And yeah, I mean, definitely the growth has been pretty exponential and we'll definitely cover that later on in the video. So then the first thing that we should go over, right, is there's this whole concept of short-term strategies versus long-term strategies, right? Fundamental analysis, technical analysis. Let's go over that. What is the difference between the two? And, you know, with someone getting into this for the first time, what should they be looking at?
Right. So you've actually asked a lot of questions in one, long-term, short-term and everything. But so I personally, I feel I'm more of a long-term investor. I like to buy some stocks and just keep them away and then hold them for as long as possible. I don't really sell too many of the stocks that I buy. That's one. And, on the other side, there is also this trading aspect where you can buy through futures and options or through stocks itself, get some short-term exposure to the stock market and then exit soon enough. But that is something, I mean, I feel is very risky. And most people, 90% of the people, when they do that, they end up losing some money. And so it's best to buy the stock and hold it for as long as possible. And then it's like buying an appreciating asset that's going to give you dividends over a long term. Like
so I mean that's pretty interesting, right?
They buy real estate and they buy real estate and they forget about it, and they never really think of selling it, or they don't care whether the price is going up or down in the short term. In the short term, I mean 2 years time. But then after 10-15 years, they consider, okay, now the value of that real estate has gone up by 10x or 5x, and then they sell it. According to me, stock market can give the same returns, if not higher. You definitely have to choose the right stocks. Even in real estate, you have to choose the right location and the right sector, things like that. So stock market investing is a lot like real estate. People in India are very open and good with real estate investing, but they're sort of scared of the stock market, which is something that limits their upside potential, I feel.
So this is a really interesting way, right? Like I think for most people, they look at the stock market and they're like, okay, there's so many companies, so many different strategies that could be applied, or so many different products available. Right. I think for anybody kind of getting into it, what you should do is look at stuff that interests you, products that you have used. And this is something I think even Warren Buffett's talked about, that he invests in Wrigley's because he knows what Wrigley's is. He drinks Coke So he
So
invested in Coke, or so he says, but like it was probably a good way to promote the product as well.
for sure, exactly. And he bought McDonald's also back then. And Warren Buffett is a bit different. He buys the stock and then he uses the product also a lot, and that's how he judges whether the quality of the product is going up or down. And he sort of, matlab, that's an aspect of the matlab, really getting into the real world. But I think otherwise, there are a lot of stocks that should be bought. One should go sector wise, see what products we use in the daily. For example, Gillette, Malab people use, or toothpaste brands, and all of these are really big, good FMCG companies that can be bought at any time and for the long term, and they will pay high dividend.
So let's do it. Let's look at a company specifically. For example, you talked about Gillette. Now we're looking at Gillette. Right. I can see market cap, stock PE, current price, book value. What does this mean? What is all of this?
Right. So, I mean, I can explain to you exactly what this is. Market cap, for example, is basically the total market capitalization of the stock. How we calculate market cap is basically the price per share into the number of outstanding shares. So this company, the current price of this current market price of the stock is 5,500 rupees. And that into the number of outstanding shares gives us the market cap. So market cap is just something to sort of go by on the side. This is a large cap company or it's a small cap company. Other than that, it doesn't have too much impact on the fundamentals, according to me.
And what exactly are outstanding shares?
Outstanding shares are the number of shares the company has issued from the beginning to now. Every company has an authorized capital and an actual share capital. So the total number of shares doesn't actually matter because, for example, Berkshire Hathaway, a single stock is $350,000. Right now. So, and they have never given out more shares than they did originally. Other companies, they normally end up increasing their number of shares every few years, and that way their stock price doesn't rise as much as it can.
I got you. So essentially, it's the number of shares available for public market buying.
Correct.
Right. So 17,000, now you mentioned something else, small cap and large cap. So what would this 17,000 crores in the Indian stock market context be?
This would be a large cap only in India. Anything over 10,000 crores can be called a large cap. Anything below 10,000 and more than 2,000 crores can be called mid cap. And anything under 2,000 crores can be called a small cap. And these definitions also keep changing.
And these definitions keep changing. This is, of course, a range, but generally looking at the amount of companies we have, the average market cap, we can estimate that anything above 10,000 can be considered a large company. And of course, Gillette being such a valuable brand, it's common to think that this is a large, successful company. So Vedant, let's look at the rest of it, right? What is this stock PE?
So stock PE basically means the price to equity, price to earnings. Fine, price to earnings. So in this case, 54.8 means the stock price, which is 5,500 rupees upon the earnings per share. Earnings per share is basically the net profit upon the number of outstanding shares. So
is this good? Is this bad? What should somebody make of this number? What do they have to look at after this?
So by looking at the price to equity, price to earnings ratio, one can gauge whether the stock is overvalued, undervalued, or rightly valued. The stock PE for every industry is different. And so for an FMCG company, stock PE of 55 is considered not very overvalued, not very overpriced. Stock PE over 70 to 80 is considered quite overpriced. But that basically means that you are ready to pay 100 rupees right now, and you're going to earn back that 100 rupees over some period of time. So,
right. And this is also dependent on the industry, the competitive market and stuff like that. And the valuation or the price per earning that you look at may change based on which industry it's in.
Right. And based on the earnings per share, if next year the earnings per share doubles, then the stock PE for the same market price will go down by half.
Right.
So
Okay, perfect. And then let's talk about these other figures that we have: book value, dividend
right,
yield,
sure.
ROCE. What is all of this, and what do we
So
have to pay attention to?
right. So book value basically means the value of the balance sheet. What that means is that there's an asset side and there's a liability side. And so if the asset size per share is this 285 means the asset side upon number of shares, and that gives you 285. That's just the book value. That doesn't have too much. You can check out the book value to current market price, but this amount also changes if the company takes a lot of debt. If they bulk up the balance sheet, their book value will go up, but that doesn't have
Yep.
any impact on their fundamentally how much money they can earn. So this is
Hmm.
book value is just something you can see once, but it doesn't give you much actionable points.
Let's move on to dividend yield.
Right. Dividend yield of 0.89% means if you buy the share, if you buy 100 rupees worth of Gillette, it'll give you around 8.9 rupees. No, 0.89 rupees. If you buy
Hmm.
1,000 rupees worth of the share, you'll get 8.9 rupees in a year as dividend over and above the stock price movement. So one can go for a high dividend yield stock if we want to go for a safe company that gives high dividend, or we can go for a growth stock, which normally tend to give low dividend, but then the stock price appreciation is a lot more.
So
So
basically, guys, dividend is something where if you buy a stock, there's some companies which will actually pay you on an annual or even a quarterly basis for owning that stock. So this
right,
percentage is essentially the yield that you get for buying that stock,
right.
right? Okay, cool. And do we have to pay attention to any of these: face value, ROE, ROCE?
We can. So ROCE basically means return on capital employed, and ROE means return on equity. And so a company, these figures are the 37.9 and 27.3 is quite a
Hmm.
high number. Anything over 10 to 15%, anything over the bank rate is considered decent. And the higher it is, the better. The
Right.
more this is basically if the company, if you put in 100 rupees into the company, it's able to generate 37.9 rupees as uh, profit.
Capital,
You
right?
know, exactly. So
Hmm.
then if a company like this takes a 1% or a 10% interest rate loan, they will be able to generate 37.9% on that money, you know. So this
Right.
is considered very good.
Okay, awesome. Now let's look at some of these charts, right? I think this is what potentially scares people or inclines people to invest is suppose you go to 1 year and you see these massive growth or look at that, boom, and it's
Right,
increasing a lot. So what
right.
does this tell us about the company? Does this tell us how much importance should you play on looking at annual, 6 month, 3 year, 5 year? What is something that you should look at here?
Look, if we go by Warren Buffett, he says don't look at the stock price. First, you go value the company, and then you look at the stock price. Because once you look at the stock price, you get you have a bias towards whether if the stock price has fallen, you feel okay, it's cheap now, so we can potentially buy. If it's risen a lot, you by default feel oh, it's very expensive, and you tend not to invest in that stock. So I personally feel one should look at the chart just for a idea of where the stock is headed, but other than that, we shouldn't buy a stock based on this chart at
So,
all.
guys, the reason why this is important to understand, right, is that if you look at any company that is still doing well and growing, you'll see a similar curve appearing, right, where
Yeah.
it starts low, and then you'll see these minor jumps. Now, when you look at this in an expanded view, and of course, Gillette went public a long time ago, so this is over the last 15, 16 years, right? If you
Right.
look at something like this, you're like, wow, this would have been easy buy. But to be honest, in Jan 2012, when the stock dips, two or 300 rupees, it might cause you to be fearful. And that's exactly what happens, especially now when there's so many new investors, is that the price fluctuates. So if you're investing, you should look at investing in things that you think will grow over time, and do not look at the short term price. I think this is something that we all do. We all get a little
Yeah.
concerned, but
It's the human nature and tendency
nature.
to get affected by short-term movements. But if the price falls, one should, and we're committed towards a stock. If we like a stock, we should just be buying. We should have a price in mind and buy at that price.
Okay, perfect. So let's do this. Let's look at some specific segments that we want to kind of look at. And the first
Sure.
one I guess we can look at is, let's look at, for example, the airline industry in India, right?
Sure.
So
Yeah.
let's check it out. So Screener is a really cool app. You can quickly compare and look at individual companies as well as an industry by comparing competitors. And yeah, you guys should check it out if you want, if you're interested in researching and looking at specific companies. So this is essentially the top, I would say the top airlines in India,
Stocks.
which are public.
Right.
And you know, what is this? What is this showing us, Ferdinand? I mean, we're looking at 6 companies here, all of which people have either flown on or heard of. So what are
Right.
we seeing?
Right. So these are all the current public airline stocks we can buy in India, and we can see Interglobe is by far the biggest, and they have a 60% market share also. And so if we look at this chart, we can if we look at this table, we can get the market cap, the dividend yield, the net profit, quarterly profit, all of the things mentioned. This, it just helps us compare between different airlines as to how much return one is getting, how much sales a company is doing, and things like that. I mean, um, yeah.
Yeah. So something to understand, right, is whenever you look at these figures, this is a snapshot of today's time, and you can look at historical data. But something to understand when you're investing as a company is you have to have a future outlook. So for example, right now, Interglobe is doing really well. Now, this is due to the fact that they have been a successful company over the last, 10 to 15 years.
Yeah.
And also the future perspective of this company is really good. They have a lot of cash. They own a lot of real estate besides their main airline business, and they're
Right.
not really going anywhere.
And another headwind that they can get, tailwind, my bad, is the
Hmm.
fact that Jet Airways has already shut shop, and Air
Yep.
India is not doing very well, and they might be sold off to a private buyer. SpiceJet is also not very strong, and all the
Yeah.
other airlines in India, they all combined, they have a 40% market share, all the other airlines, and all of them are struggling. And Indigo, for one, has good cash buffer. It has low interest, and their entire business model is actually a lot different to most of the other airlines in India. They don't actually buy their planes; they lease them out. They only have one kind of Airbus plane. So all their technical engineers, all their people are focused on that one kind of aircraft, one kind
Yeah.
of engine. And all the other airline companies in India, they have Boeing, they have Airbus, they have different engine manufacturers. So their processes are more complex compared to Indigo. And Indigo, that's why, is slightly more efficient. Their business model is good, and I've
Yeah. I
flown
mean, look,
Indigo, and I like the flying experience also.
it's at the core, it is quite simple. Look at companies and products which work well, which you like, your friends
Yeah,
like, your family like, and then see whether you see them growing in the long term, right? So if you look
right.
at all this historical data for Indigo, we can see that it's exponentially grown over the last 10 years.
Right.
But now what you should do is take this figure and see, okay, where could it potentially go in the next 5 to 6 years?
Right.
Look at the competitors, look at the airline industry, look at COVID as a situation,
And even look
and
at
see.
India, the fact that we are in India,
Look at India.
and
Yep.
India is going to grow, and so all these industries will grow with that. It'll be hard
Yep.
for a specific industry not to grow. And we have a $5 trillion target in the next 5 years. That's doubling from the current 2.4. So that is all the entire stock market should basically double in 5 years to 7, 8 years time.
Yeah, so this is really important to understand. I think a lot of people, or there's this whole concept that during the first lockdown last year, there was a lot of retail investors that jumped onto the stock market, and people are like, oh, that's why prices are increasing. But something to understand is most of those guys do 3 to 5 trades, leave, and then never get burnt a bit, and then never go back to investing as well. So
Yeah.
and the size of the stock market in India, the amount of retail investors is so small.
Yeah.
So there's
No,
only
that's
opportunity for it to grow.
Yeah, no, for sure. So in India, for example, I mean, with 130, 135 crore people,
Yeah.
and about 2% of us have a demat account that enables us to invest in the stock market. So that is quite a low penetration in that sense. For example, US and Europe, they have more than 70%. 70% of the people have access to the stock market. So that way, the retail space is only going to grow. Currently, market is influenced and run by the institutional investors in India. So the retail investors get burned, but we should not lose hope. And we should just like.
So let's talk about this, right? We've looked at some individual stocks. We've tried to understand what they do. What are some of the products that, suppose I want to do this, where, you know, it's something I never have to look at. I don't have to think about. I have some disposable income, let's say 5% of my salary or 10% or 20% of my salary on a monthly basis that I'm able to deploy. What are some of the products that you would recommend or ask people to look at?
So for a lot of the people, investing through mutual funds is fine, because it's very difficult to do the fundamental analysis ourselves. So one should just have a goal in mind that I want to achieve. I have this much time on my hands. I have a 20-year target, and I want to achieve a 15-20% return a year. And after 20 years, I'll have this, let's say 10 CR on a certain amount. And that way, there are a lot of mutual funds. For example, a balanced advantage fund is something that is one of the best saving tools available right now. And balanced advantage fund basically handles your money, and it invests between equity and debt in a very safe way. And so they will invest in safe equity stocks, which will give you a decent 15-20% a year. And in case market falls, before the market falls, they will shift that money to debt, so that downfall is limited and upside is around 15%. So you get a balanced advantage, as it says. You get the both sides. You get the advantage of both sides.
Yeah.
And there are a lot of them. I personally have invested in Icici because I like their fund manager, and they're the biggest balance fund in India. That is just one point. All of them are going to give you very good, around 12 to 15% in a year, in a very safe way.
Right. So something to understand here is that this is just our opinion. Neither one of us are super qualified financial analysts, but these are products that we both have bought with the expectation that there's some growth opportunity available. And that's why we're okay talking about it. Do your own research, do your own analysis, and don't come crying to us if you lose money, because, you know, it can happen.
For sure. That's nice.
Okay, cool. So let's look at Icici Prudential Balance Advantage Direct Fund, right? Like, what is in this? How does this work? How much you have to put in, and how does this, you know, kind of happen?
So I think the minimum amount is 500 or 1,000 rupees. That's the minimum amount one can invest, and then there's no upper limit to that. Other than that, there's an exit load for 1 year. So you will have to pay a 1% exit fee in case you pull out your money in the first 365 days.
Right.
Other than that, it's quite good. There's another point towards mutual funds, which is a lot of people go through the commission route when investing in mutual funds. They go through their stockbrokers, which tend to charge a 1%, 2% commission upfront. Whether or not you know it, it's baked into the price. So the best way to go for mutual funds is to go through direct way, which is there are a few brokers that offer the direct way. Coin Zerodha is one, and there are a lot of others. Most of the discount brokers, they don't charge a separate commission fee, which CAMS and most of the other mutual fund aggregators in India, they charge a good commission fee, which one should be wary of.
So one thing to note is, if you set up a DMAT account, 90% of the well-established banks like HDFC, ICICI Bank will have some form of a securities platform which you can use to buy these. However, they do charge a lot of money. So that's something to consider. Discount brokers, and we'll get into Zerodha and some other platforms, which you can use. They're super, super cost effective, and they're also easier to use than most of them. They have good UI, UX. Right. So this... And something to touch upon, right, is like most of these products give you an estimated return based on the interest that they have received previously, right? So you can get an idea of what it looks like. For example, if you have, let's say, 10,000 you're putting a month, what you will receive in 1 year, what you can receive in 3 years, what you can receive in 5 years. Now, something to understand is that these figures are, of course, based on estimates and what they think you will get. But looking at the previous track record of how these products are working, and even over the last 6 months, they're pretty safe investments, which is probably very important to most people. And they're also something which can give you a higher than expected return as compared to other products. So we're looking at ones that we think work better than the rest of the mutual funds out there.
Correct. And yeah, one should go for safe investments only in the stock market, because you never know when the market falls, and the risky bets are the ones that suffer the most. So, and also when there's a bear market, one should invest all the money they have into the stock market, because market only goes up in the long term. Bear market is the opportunity to invest.
And this is like what you want to look at, right? When you're looking at some of these mutual funds, is where that money is split up, right? So basically what happens is these fund collectors get a pool of money, and then they put it into different sectors or stocks that they think would be beneficial, right? So you should check it out, right? Because this also gives you an idea of what the risk tolerance for that is, right? If it's very based on tech and alternative energies, then you know that it might be riskier. But if it's something a little safer, if there's a higher percentage on, for example, energy or something like that, then it might be.
Or healthcare, or
healthcare.
Healthcare or FMCG is also quite safe.
Yeah.
Considered.
And yeah, I mean, like, these returns are pretty crazy. So this was really interesting, right? And let's talk about what happened in March 2020. Like, what was this like for you personally? What did you see? And, what can people learn from situations like that?
Right. So March 2020 was a humbling experience, to say the least. It was a situation of markets falling 5%, 7% daily, every day for a month. And by the end of it, market fell from 12,500 to 7,300 at the bottom, and within 20 days. So that was and not a normal time at all. But what I learned from there is that markets, they get very scared and pessimistic when they react to most bad news and to good news. But so one should just take advantage of the fall in prices. So I was reading somewhere that back in 2008, the share price for Bajaj Finance was 4.8 rupees.
Damn.
In 2008, 13 years ago. Bajaj Finance. At the bottom of the stock market, at the bottom of the 2008 financial crisis. But even then, market gave a lot of opportunities even after that. And you can imagine 4.8 rupees to the current 5,500 or FinServ also is return of more than 1 lakh rupees would have become 7 crores approx.
So yeah, I mean, I hope
13 years only.
Look at this. If you had bought it in March
also
of last year, 4,500.
Yeah,
that's the bottom. 11 grand.
12 almost. So
look, I mean, this just goes to show you, right? Is that just invest in the long term, right? Like, money you can only make slowly. So guys, what we're going to do now is we're going to talk a little bit about compounding and how important it is to start early, start in your 20s, your late teens, or even if you're 30 years old, 40 years old, that's okay. You can start compounding because it's always going to increase your money. So what is this we're looking at? Why am I looking at Karishma Kapoor and Kareena Kapoor?
Right. So this is just a video that I was shared recently, and this talks about how the power of compounding, right? And in the power of compounding, Ramesh Damani, he's one of the very famous and big investors in India. His net worth is more than $10 billion. So, and he's made it all through investing.
Wow.
Fine. So you can 70,000 crores or something, so you can imagine. But so he talks about the power of compounding, where one person invests for 7 years, 50,000 rupees a year, and in total they basically invest 4 lakh rupees.
Yeah.
Right. And then there's another person that starts investing at the age of 25, saves the same amount, right, every year, does it 38 times, saves 19 lakhs, and when they're 40, you can just see the difference in value. At the age of 16, someone who starts early is at a huge advantage. And the point is, if you start early, you start investing at 18, you don't need to stop at 25. You continue saving and investing, and the amount of money you will make is just going to increase.
Let's check it out.
Done.
Karina is the fun one. She wants to have a good time, go out, party, buy clothes, travel. So she starts saving when she's 25 years old. Karishma stops saving when she's 25 years old. So she saves for a period of 8 years. Karina saves the rest of her life. Till 62, she saves every year. How much do they save? 50,000 rupees a year. 50,000 rupees har saal karte hain. But what a difference it makes because Karishma started early. And then when she's 40 years old, she has 55 lakhs, 50, 2.25 crores. When 60, she has 12.8 crores. Whereas Karina, who saved for 40 years, ends up with only half the amount. So, jaldi shuru karne ka itna advantage hai. Compounding is so great an advantage when you start early. So the one lesson I'd like these young people here to take away from you is start investing early. Even small amounts invested early make a huge difference 10, 20, 30 years down the road. Let me put it in words that you will understand. Most of us will have a career of about 30 years. 30 years in the financial markets, 30 years as an architect, 30 years as a doctor. A professional career, 30 to 40 years come there. Let's say 30 years out there. Let's say you start off life when you're 25 and you save your first 10 lakhs. आपने 10 लाख सेव कर दिया कैसे भी मेहनत करके 10 लाख बचा दिया आपने. Now you're able to double your money every 3 years. All right? Every 3 years you're able to double your money. The index itself goes up 16%, right? So to double your money, you need to do about 21, 22% a year. It's not that hard. If you double your money every 3 years,
let's just
in a 30-year career, you'll have 10 doubles in your life.
Yeah.
So what he's talking about, like, look, I mean, this is a thing which is I guess common for successful investors is, and I guess these types of investors, right, is they're very bullish, right, and they're very aggressive
optimistic
in
and overly optimistic also.
The compounding or the interest that you can gain on an annual basis. So what he has said is that the index is growing at 15% annually, whereas you should be looking at anywhere between 20 to 22% on annual growth. Vardhan, in your experience, what are you kind of doing on an annual basis for the last few years?
Right. So it's not easy to beat the index. Yeah. Best way to invest, according to me, whatever said in safe way without doing much work, is to invest in the index, all your savings. So that will give you a 15% return, and you don't need to do much because it will keep juggling the portfolio. Other than that, if you take advantage of any bear market, when the market falls, I got lucky. I invested a lot of money when the market fell in March, and then invested some more in April, May, June. And that has given me probably a 50-60% return since then. And so that is good. But the market also has probably risen by a similar amount. But I've probably just beaten the market by 2-4%, not more than that.
So I think and that is really important, right? Is like, you have to be realistic, right? But at the end of the day, it doesn't really matter. The point is to keep sort of a set pattern that you're looking at investing the same way that you would look at, working out or something. You have to do every day, and over some time you will see incremental improvements. So before we move any further, I think we should talk about what an index is, why should you care about it, and what has it got to do in relation to the stock market?
Sure. So an index is basically a group of stocks that the group of large cap stocks in the stock market. For example, there's Nifty 50 and Sensex in India. Nifty 50 is an index of the top 50 stocks in India, and Sensex is the top 30 stocks in India. And the index basically just gives you an indication of where the market is going. There's no other of where the top 50 stocks are going, not even the market. But it's a very safe way to invest because the top 50 stocks are probably stronger than the rest, and it gives you a good good
indicator.
Exposure. Yeah.
So basically, like exactly what Vedant said, right? And you can Google it and kind of research what companies make up the Nifty 50, but they're essentially just the largest companies
Top 50.
that the Indian stock market has.
Correct. And so every 6 months that list changes, and they tend to remove one stock from the 50 list and add the next biggest, because every 6 months prices change every day, and so
Yeah.
they have a policy of changing the index every 6 months.
Yeah.
And so you just get that exposure as well. You get to add some stocks and remove some stocks.
Yeah, and it's very, very easy to find. You can visit the NSE website. You can visit multiple websites to have a look at which 50 companies are there, how they are performing, which ones you can look at. And look, it really isn't rocket science again. Look at some of these companies. You've either bought their products, heard of their products, or interacted with them in some way. And these you can consider as safe bets. So for example, if you invest in only HDFC or only Maruti, there's a chance that one of these companies could fail. But if you look at a combination of these companies and you buy this index fund explicitly, you're kind of hedging against a global meltdown or something like that, essentially.
Yeah, and you are basically then diversified. You have all the different sectors and industries in India in the index, and so it's a good way to earn. Warren Buffett always says no fund manager is able to beat the stock market. He talks about how he had a bet with all the private equity and hedge funds of the world that if you can beat the stock market over a 10-year period, I will give you $1 million. And as it turns out, for that 10-year period, nobody was able to beat the index, not even Warren Buffett himself. Okay? So index investing is a very good, safe way to invest, but one wants higher returns than the index, and so one tends to go for some other. And the thing with the index is, it's at the end of the day, it's exposure to the equity market. An equity market is risky inherently, and so there is only, it's a safe way to take risk. So one should be very one should know that when you're investing in the index, market will fall every year. There will be at least 1 or 2 times where market falls more than 5% over a week or a month. So, yeah.
So, look, if you're kind of looking at the stock market as a way to make money tomorrow or a month, 2 months, 3 months, 6 months down the line, you probably should relook at what you're doing, right? Look at other opportunities to make money, maybe invest in skill sets, maybe get into freelancing or doing jobs for people, or look at how you can, provide value to someone in the short term. If you want to make money,
you want to
don't invest in the stock market.
Wealth over a long term, you go for the stock market. If you want stock market, you can't really make money in the short term much unless you are gifted in doing trading or whatever. Like you have some good thing. It's very difficult. 99% of the people lose money and they tend to quit the market. Market is a place to make long-term money, and we are lucky that we have a stock market. One should just invest, and for the long term, it's And
so I think one way you can make money in the short term in the stock market is if somebody gives you 50 lakhs, you lose 25, you make 5. So net, you've made 5, but you probably lost 30. So the only money you can do in the short term. So let's talk about quick cash, right? There's all these other asset classes emerging. One of the biggest ones being cryptocurrencies. Vedant, what's your Doge scene like?
I haven't invested in Doge because I personally think it's a meme stock and meme crypto, and so it's going to get pumped up. It's going to go up. So one can invest, buy some Doge for a week or 2 or a month. But Doge doesn't have any underlying. It doesn't do anything. It's not providing any value. That way, Ethereum, for example, is a very good blockchain that's become a platform that enables a lot of things, and it could be from content delivery to as a currency to a lot of things. So if you're buying a crypto, especially in the current scenario, one should go for some cryptos that are providing value and they actually have some product. Okay. You can look at Ethereum. Ethereum is good. There's Polygon Matic that basically makes Ethereum a more efficient market. It makes Ethereum more efficient. So Ethereum has all the broad-based capabilities, and those are made more efficient by Polygon-Matic.
Yeah, so it's so funny, right? Like the good thing. So one thing to understand, right? The stock market is only open for specific hours, from 9 to 4, and whatever damage you want to do to your portfolio, you can do in those hours. The good and bad thing with cryptocurrencies is it's 24/7. Whenever you want to, you can pump a stock, you can pump a crypto, you can dump it, and
correct.
so
Even
that
over the
has
weekend, anytime. It's
anytime, and that has interesting implications, right? Because with stock markets, they're limited to what's happening within the country's time zone, but with cryptos, it's everybody aggressively trading and looking at different situations happening.
Right.
Yeah. So let's look at some, right? Like, so let's look at Ethereum. So first thing is, I mean, look, we don't understand the technology explicitly. And to be honest, if this is something where you're saying, I want to become a crypto investor or I want to invest in blockchain or technology, first thing you should do is educate yourself on this, right? If this is something that you do not understand, you're looking at Instagram, you're looking at what your friends are saying, you're like, let me buy it. You should be prepared to lose all of your money, right? If you're putting 50,000 rupees, 10,000 rupees, 5,000 rupees, and you're buying cryptos, you better be comfortable losing the whole thing, and if not more.
Yeah, like if you take now there's crypto futures and options and all, so that leverages your portfolio. You could lose more than you put in. And that's the short way to go broke and bankrupt. So definitely don't go for any futures and options in an asset which is so volatile. And if you buy the shares, then you should buy a crypto. Then you should have some analysis, do some fundamental analysis of the crypto.
Yeah. So for example, so if you really do want exposure to these, I mean, keep it safe, keep it simple. Ethereum, Bitcoin, XRP, all the ones listed here are probably ones which in the long term have some intrinsic value, which is what we are kind of looking at. However, meme stocks, meme coins, if you are prepared to lose, 1% of your portfolio, investing in cryptos in total, and then you take a percentage of that and invest it into these meme stocks, it's up to you. Just be prepared to lose it. Do your own research, try to understand how this technology is being utilized. That's actually more interesting. Maybe it's something you could get into if you are genuinely interested into it. And
blockchain as a technology or as a method is actually revolutionary, and it does sort of change the way a lot of industries work. For example, banking, it can really change banking because there's no need for a centralized person regulating the transactions and actually signing them off, things like that. It's all done automatically through the blockchain network. So that half the reason why we aren't using cryptos more is because banks don't want us to. Banks only make money when we exchange, we pay someone or get money. So that is one of the reasons. But in the long term, blockchain is something that's going to change the way we function. It's like a currency for the internet. Internet is very common in today's day and age. Eventually, cryptos and blockchain is going to be as relevant and part of our everyday life, as the internet is.
Yeah, I mean, so just like an example, right? This is I got really lucky, but back in 2014, I bought one Bitcoin, and I think I was in the UK, so it was like 250 pounds, right? And look at where it's at now, and had absolutely 35,000 pounds or something, and it had absolutely nothing to do with investment or studying. It was a punt, and I got really lucky. So you can't really factor luck into a strategic portfolio. However, you have to look at your own risk appetite, right? Look at your age, look at your income, look at your own earning possibility, and most importantly, look at the dependencies you have. You have to give money back home. Are you married? Do you have kids? And that's why starting young.
There's this rule called the 100 rule, which basically means you can divide your age by 100, and that gives you a rough idea of how much you can invest in equity versus debt. So if we are 25 years of age and we do this rule, so 75%, 100 minus 25 is 75, and one should invest 75% of their investable income into stocks or equity, which is more risky, but because we have so much time on our side that we should take that risk. But for someone who's 60 years old, they should definitely not invest more than 40%. or even less in equities, and 60% in debt.
So I mean, like let's talk about why it is so important to invest your money, right? And the biggest reason is this stupid thing called inflation. What is inflation doing to your cash in the bank?
Inflation is the biggest tax in the world, and it's the hidden tax that no one knows about, no one talks about. But in a country like India, our inflation officially is 6%. Unofficially, it's 25%. Okay, maybe not 25%, but it's like more than 15%. So what that does is, if you're making 100 rupees this year, next year, that same 100 rupees is actually worth 85 rupees. And then the year after that, it's losing another 15% to give you around 65 rupees. And so every year, whether or not you're making money, inflation is eating away some amount of purchasing power. Fine. So if you just keep the money in the bank, also you're earning 4% or whatever, but you're still not covering your inflation costs. So if you don't invest, you are just about conserving your funds. And if you invest, then you are making some money on the funds.
So I think this is so important, right? Look at your own examples in your daily spending. Look at the cost of a bottle of water or a t-shirt at H&M or something like that, right? Over the last 5 years, all of these things have got more expensive, but your value of the rupee that you have in the hand has either decreased in value or has maybe slightly, moved up and down a bit.
For example, the dollar from 2008 to right now, dollar in 2008 was around 25-30 rupees, and right now it's more than 75. So
Crazy.
that is just shows you that's one form of inflation. But then also the taxes and everything else going up. Inflation, especially tax on fuel, is the direct way to increase inflation. Let's not go there. I'll get too much into this politics. Fine.
But so for sure, I mean so basically what we're trying to say, right, is be strategic about your investment, do what is comfortable for you, but do it. Because if you leave money in the bank, it is essentially burning it every year a little bit by little bit. So invest your cash, try to make something. Yeah.
And one should target at least a 10 to 12% return on investment in the stock market. One should target that. One can achieve 50, one can achieve 25. It's in the long term, we can achieve a lot more. And if you double your capital every 3 years, that's 22%. And that is real compounding. Then 10 lakh rupees over 30 years at 22% is going to give you 100 crores in 30 years. 10 lakh rupees.
And I think investing is like unlike any other sort of like I don't even like skill set, or forget skill set is not the right word, but anything else in terms that it'll increase and get better over time, even if you don't learn anything about it or do anything. Right? For example, if you're running Facebook ads or you're doing anything else, right, you need to get better at it every day, right? So if you're not trying to become a day trader and you just want something where you can park your money and over time it'll increase, and you're putting like a SIP or something like that, this is probably the best way to do it, right? Let's talk about that, right? Like what is a SIP?
So SIP is basically a systematic investment plan, and it is the best way to invest in India. And it's basically like investing a set amount every month, and that way you are just increasing your portfolio and getting rich.
Yeah, and if you are thinking of buying the new iPhone or new OnePlus phone, and you're looking at this no interest EMI and are getting excited, don't do that. Put your money in a SIP instead. You can buy 3 of them in a year's time.
In a year's time, correct.
Yeah.
If you like a product and the company is doing well and their products are good, one should buy their share as well, because if you see that they are making money, why not own them and make money with them while buying their product? If you back in the day bought an app when Apple came out with the iPhone, or even when they came out with the iPhone 4 which was I think 2012 and all, back then the price of one share was under $3-4, and right now it's like $300. So
so your iPhone went from being $400 to 200 the second you left the shop to zero in a matter of years. Your same Apple stock could have bought you a house and a Lambo possibly if you had bought it at that time.
Exactly. So buy the phone and buy the stock. Buy both, fine. Or don't buy the phone. Just first buy the stock and then buy the phone.
Buy the stock, use your dividends, and then buy the phone.
Yeah, no, legit.
Yeah,
that's the best way. And if your portfolio is earning a 2% dividend in a year, on a 1 CR, you're earning 2 lakhs a year just in dividend. That can buy you your phones and
So
everything.
let's I mean, we mentioned dividend earlier, but let's talk about it, right? Suppose, this is for maybe somebody slightly older, somebody who's, had some good fortune. Let's say you end up with 50 lakhs ready to invest. How can you park that 50 lakhs so that you are getting a monthly check every month so that you can cover at least your basic costs?
Right. So, how to go about that is not very easy. Also, one has to basically decide what is what is their risk profile. If you are a risky investor, go for equities. If you are a safe and a very conservative investor, then one should go for debt. In debt, one can expect a good 8 to 10% return in a year, and in equities, one can expect around 12 to 15%. And if we go for a very aggressive equity fund, then we can expect around 20%. So one has to look at their own risk profile and accordingly invest. 50 lakh rupees is a very good sum to start off. One should go for both equity and debt. Maybe if you're under 30, one should go for at least 70% equity, 30% debt. But if one is over 40, 50, then we can choose and accordingly go for the right.
Yeah, and this is really interesting. I also recently learned about this, right? Each bank that you work with, or each one of these companies, right? They have something that's called as a relationship manager or a financial advisor.
Right.
These guys will talk to you and open up and give you access to any piece of information that you would want. So take your time, talk to these experts whose job it is to know and learn everything about these products, and ask them questions that you would want to know, right? What is there any exit load? What is the interest like? How much money can I get in 5 years? Give them your objectives, right? Your objective might be that you want 1 lakh a month in disposable income, right? So figure out how much you need to invest and what products you need to invest to get that. Your objective might be that you want to pay your child's tuition, college tuition in the next 5 years or 10 years or something. So talk to these people, talk to these experts, and figure out what you need to set up to make that happen for yourself.
Right. Exactly. Yeah. And so there are a lot of dividend-paying mutual funds. There are dividend-paying stocks. Like in India, there is ITC, which is a very big, it's a stock and a company we use daily for different things. And they pay a good 7% dividend in a year. So that is something that one should, that is a very good dividend yield. And imagine on 1 lakh, you're getting 7,000 rupees a year just in dividend, which
Amazing.
is a solid amount. If you have a big sum, that is a good return. And plus the appreciation and there are other public sector stocks that give more than 10% dividend yield in a year, just because their stock price is so low. It's not that they're paying high dividend. It's more that their stock price is just like at 1/10 the stock price of same private company.
So I mean, definitely take advantage. I think I don't know if it's maybe it's just got to do with the way the Indian stock market is set up, but companies offer very high dividends in India for some reason, right? It's still like new or maybe people feel more comfortable. So find these companies, right, which give high dividends if that's a priority to you.
Yeah.
And earning up to 7% is it's a huge amount, right? You put like Vedant said, you put 1 lakh, you get 7,000 chilling.
And this is just guaranteed return, and this dividend every year will rise. Every year they'll step it up by 10%, so you'll get 7 point, almost 8% the next year, and even more the next year. So your dividend amount on the original investment will also increase. Stock price should also increase. So potential is a lot, but also I'm over optimistic. So maybe it's not fully low, but still.
So be optimistic, don't be over optimistic.
Yeah.
Sure. Try to keep your investment strategy more for the long term. Look at your objectives, look at your disposable income, invest in cryptos if you're okay losing the money, and do your research most importantly.